Hello, my name is Doug Greenberg, and I'm the founder and president of Pacific Northwest Advisory. On a monthly basis, I create a video discussing a variety of topics. This month, the format is new, as I'm covering 5 charts in 5 minutes. So, let's get going. First quarter performance of the S&P 500 was driven by outsized returns from some of the largest names in the index. Performance leadership rotates frequently between the largest companies and smaller companies. The performance news from the first quarter was all about the top 5 contributors to the return of the S&P 500. The top 5 contributors were 66% of the return and drove the growth indexes higher as compared to the value indexes. This was not a broad, market-based quarter of performance, but narrow, which shows the lack of conviction in the overall US markets. This is not a signal to overweight growth currently. Many major economies face maturing business cycle trends due to persistent inflationary pressures, slowing industrial activity, and tightening monetary and financial conditions. The US is in the late cycle expansion phase with a rising likelihood that a recession may be on the horizon in 2023. Europe has likely tipped into recession, but the Chinese lifting of COVID restrictions and policy stimulus offer hope for a 2023 upturn. From an asset allocation perspective, slower liquidity growth, persistent inflation, recession risk, and greater monetary policy uncertainty raise the odds that market volatility will remain elevated. Some of these challenging dynamics have been priced into markets in the form of attractive valuations, particularly in fixed income and non US equities. The onset of a recession typically implies a challenging time for riskier assets and outperformance of more defensive categories. The fallout from Silicon Valley Bank has rippled across the industry, and banks are tightening lending standards. The labor market will be negatively impacted by the tightening of monetary policy and bank lending, but remains relatively resilient given the strong demand for workers. Employers will reduce the pace of hiring and allow positions to go unfilled, but will keep layoffs to a minimum with a fear that they will be unable to hire quickly when the economy begins to reengage. The unemployment rate is expected to modestly increase to just over 4% by this time next year as a result, and small businesses are reporting that it's increasingly difficult to get credit, which will further slow the economy. As US Fed Chair Powell admitted, the current bank stress will tighten credit, with the result being the equivalent of a rate hike or perhaps more than that. While the bank run was and is bad, it has slowed the economy directly. Absent more banking issues, it appears to have reduced the need for prolonged Fed increases. Nominal wage gains continue to lag price increases, implying a decline in real wages. Somewhat paradoxically, this is happening while the labor market is very strong, with firms posting many vacancies, and while labor supply remains weak, many workers have not fully rejoined the labor force after the pandemic. Although there are currently 9.9 million available jobs, down from the peak of 12 million in March of 2022, initial claims of unemployment insurance are below their peak from back in 2022, as non-farm payroll new hires are still positive, tracking above 200,000 per month. Unemployment needs to move higher before wages decline, and hence inflation declines further. Leading indicators provide advanced warning of where the economy will go in the future. This chart shows the very popular and well-studied Conference Board Leading Index. It's clear that the growth rate turns negative before the economy enters a recession. The US Leading Economic Index fell for the 11th consecutive month in February, with negative or flat contributions from 8 of the 10 components, despite improving stock prices and better than expected residential building permits. The leading economic indicator still suggests a risk of recession in the US economy, while the rate of month over month declines has moderated. Recent financial turmoil in the US banking sector is not reflected in the data and could have a negative impact on the outlook if it persists. The Conference Board forecasts rising interest rates and declining consumer spending may lead the U.S. economy into a recession in the near term. Thank you for taking the time to view, and please let me know if you have any questions. Thank you.